What if everything you thought you knew about financial markets was completely wrong? What if the very foundations of modern economics were built on a massive lie that cost millions of people their homes, their savings, and their future? In 2008, while Wall Street was burning and the global economy was collapsing, one man stood up and said he saw it coming all along. That man was George Soros, and his warning wasn't just about the crisis itself, but about something far more dangerous: the entire way we think about money, markets, and reality. Today, we're diving deep into one of the most controversial and prophetic books ever written about finance. This isn't just another boring economic analysis. This is a complete demolition of everything Wall Street told you was true, written by the man who made billions betting against conventional wisdom. Soros didn't just predict the 2008 financial crisis. He revealed the fundamental flaw in human thinking that makes these disasters inevitable. But here's where it gets really interesting. Soros claims that every economic theory you've ever learned is based on a scientific impossibility. He argues that the very idea of market equilibrium is not just wrong, but dangerously delusional. And the most shocking part, he believes this delusion is so embedded in our thinking that we're destined to repeat these catastrophic crashes over and over again unless we completely change how we understand reality itself. George Soros wrote The New Paradigm for Financial Markets in the aftermath of one of the most devastating financial collapses in modern history. Published in 2008, this book represents more than just an analysis of the credit crisis. It's Soros' attempt to fundamentally reshape how we understand the relationship between human perception and market reality. Soros brings a unique perspective to this analysis. He's not an academic economist sitting in an ivory tower. He's a battle-tested investor who made his fortune by consistently betting against conventional market wisdom. His most famous trade, breaking the Bank of England in 1992, proved that even the most powerful financial institutions can be wrong about market fundamentals. This practical experience gives his theoretical insights a weight that pure academic analysis often lacks. The timing of this book is crucial. Soros wrote it while the 2008 crisis was still unfolding, giving readers a real-time analysis from someone who had been warning about these exact problems for years. Unlike many post-crisis analyses that benefit from hindsight, this book captures the immediate insights of someone watching his predictions come true in real time. What makes this book particularly powerful is Soros' willingness to challenge the fundamental assumptions of economic theory. He doesn't just criticize specific policies or institutions, he attacks the philosophical foundations that support the entire modern financial system. His central argument revolves around what he calls the theory of reflexivity, which suggests that human perception and market reality influence each other in ways that make traditional economic models useless. Soros also brings a philosophical depth that's rare in financial literature. Drawing from his background, studying under philosopher Karl Popper, he applies concepts from the philosophy of science to market analysis. This interdisciplinary approach allows him to identify problems that purely financial analyses miss, making his critique both broader and deeper than typical market commentary. The New Paradigm for Financial Markets centers on Soros' revolutionary theory of reflexivity, which challenges the core assumption of modern economics that markets tend toward equilibrium. According to Soros, this assumption is not just wrong, but catastrophically dangerous because it ignores the fundamental role of human perception in shaping market reality. Soros argues that financial markets are characterized by a two-way feedback loop between participant perceptions and actual market conditions. Unlike natural sciences, where theories don't affect the phenomena they study, in financial markets, the beliefs of participants actually change market outcomes. When investors believe housing prices will continue rising, their behavior creates the conditions that make prices rise, at least temporarily. This creates what Soros calls boom-bust cycles that are inherent to market functioning. The book traces how this reflexive relationship created the conditions for the 2008 financial crisis. Soros identifies the widespread belief in market fundamentalism, the idea that markets are always right, as a key factor that allowed dangerous bubbles to inflate unchecked. Regulators, investors, and policymakers all bought into theories that claimed markets would self-correct, leading them to ignore mounting evidence of systemic risk. Soros traces the intellectual origins of the 2008 crisis to the rise of what he calls market fundamentalism, a belief system that treated free markets as infallible mechanisms for allocating resources. This ideology emerged in the 1980s under Ronald Reagan and gained momentum throughout the following decades. Market fundamentalists argued that government intervention in markets was always harmful and that deregulation would lead to greater efficiency and prosperity. Soros demonstrates how this belief became so entrenched that it influenced policy decisions across multiple administrations, creating the regulatory environment that made the crisis possible. The problem wasn't just that this ideology was wrong, but that it became a self-reinforcing belief that prevented people from seeing mounting risks in the financial system. Unlike typical market bubbles that affect specific sectors or assets, Soros identifies a superbubble that encompassed the entire global financial system from approximately 1980 to 2008. This superbubble was characterized by steadily increasing leverage, growing financialization of the economy, and the emergence of increasingly complex financial instruments. Each smaller crisis during this period, from the savings and loan collapse to the dot-com crash, was resolved through measures that actually made the underlying system more fragile. Rather than allowing necessary corrections to occur, policymakers repeatedly intervened to prevent short-term pain, then inadvertently creating conditions for a much larger eventual collapse. The superbubble concept explains why the 2008 crisis was so much more severe and widespread than previous financial disruptions. The housing market became the focal point where abstract financial theories met concrete economic reality. Soros explains how the belief that housing prices could only go up became a self-fulfilling prophecy that drove both individual behaviour and institutional policy. Banks began treating mortgages not as long-term relationships with borrowers, but as raw materials for financial products that could be packaged and sold to investors. This securitization process broke the traditional link between lenders and borrowers, removing incentives for careful risk assessment. As mortgage-backed securities became increasingly complex, few market participants understood the actual risks they were taking. The result was a massive misallocation of capital that made the eventual correction both inevitable and devastating. Throughout the build-up to the crisis, sophisticated mathematical models convinced market participants that they had risk under control. Soros reveals how these models were based on historical data that didn't account for the reflexive nature of markets. The models assumed that market behaviour followed predictable patterns similar to natural phenomena, ignoring the fact that human beliefs and behaviours change in response to the models themselves. When everyone uses similar risk models, their collective behaviour creates new risks that the models can't anticipate. Value-at-risk calculations and other seemingly scientific approaches gave false confidence to traders and regulators who believed they could quantify and control market uncertainty. This technological hubris blinded market participants to the systemic risks building throughout the financial system. Soros documents how financial regulators became captured not just by industry interests, but by the ideology of market fundamentalism itself. Regulators genuinely believed the markets were self-correcting and that their role should be minimal. This wasn't simple corruption, but ideological capture that made regulators unable to see problems even when evidence was mounting. Key figures like Alan Greenspan publicly expressed faith in the ability of financial institutions to self-regulate, dismissing concerns about derivatives, markets, and housing bubbles. The revolving door between Wall Street and Washington created a culture where challenging market orthodoxy was seen as economically naive. This regulatory failure wasn't just about specific policy mistakes, but about a worldview that made effective oversight impossible. When the crisis finally hit, it demonstrated the destructive power of reflexive dynamics in reverse. Just as rising prices had created conditions for further increases during the boom, falling prices accelerated the collapse in ways that traditional economic models couldn't predict. Forced selling by over-leveraged institutions drove prices down, which triggered more margin calls and more forced selling. Credit markets froze as counterparty risk became impossible to assess, creating a liquidity crisis that spread far beyond the original problem areas. Soros shows how the crisis fed on itself through feedback loops that amplified initial problems into systemic collapse. The speed and severity of the decline caught even sophisticated market participants off guard because they hadn't properly understood the reflexive mechanisms that had driven the preceding boom. The government's response to the crisis, while necessary to prevent complete economic collapse, created new moral hazard problems that Soros argues make future crises more likely. By bailing out major financial institutions while allowing smaller players to fail, policymakers sent a clear message that some institutions were too big to fail. This guarantee effectively subsidizes risk-taking by large financial institutions since they can capture upside gains while socializing downside losses. Soros criticizes this approach not just on grounds of fairness, but because it creates incentives for even more dangerous behavior in the future. The failure to fundamentally restructure the financial system means that many of the conditions that created the 2008 crisis remain in place, setting the stage for future instability. Soros emphasizes that the 2008 crisis wasn't just an American phenomenon, but revealed the dangers of global financial integration without proper oversight mechanisms. The crisis spread rapidly across international borders through interconnected financial institutions and markets, demonstrating that financial instability in one major economy could quickly become a global problem. Currency markets, international banking relationships, and cross-border investment flows all became transmission mechanisms for the crisis. This international dimension made the crisis much more difficult to contain and resolve, as no single government had the authority or resources to address global systemic risks. The crisis revealed the need for international cooperation in financial regulation, but also showed how difficult such cooperation is to achieve in practice. The most fundamental lesson from Soros's analysis is that financial markets don't operate like natural systems, where cause and effect follow predictable patterns. In markets, human perceptions actively shape reality through a process Soros calls reflexivity. When investors believe an asset will rise in value, their collective buying behaviour often makes that belief come true, at least temporarily. This creates feedback loops between perception and reality that can drive markets far from any reasonable assessment of underlying value. Understanding reflexivity means recognising that market prices don't simply reflect fundamental values, but actually help create them. This insight transforms how we should think about market analysis, risk assessment, and financial regulation. Rather than trying to predict market movements based on fundamental analysis alone, we need to understand the psychological and social dynamics that drive collective market behaviour. Traditional economic theory assumes that markets tend toward equilibrium, where supply and demand balance at fair prices. Soros demonstrates that this assumption is not just wrong, but actively harmful because it prevents us from recognising systemic risks. Real markets are characterised by boom-bust cycles, where prices swing far above and below any reasonable equilibrium point. The belief in market equilibrium leads to complacency during boom periods and prevents effective intervention when bubbles are forming. Instead of assuming markets will self-correct, we need to recognise that instability is inherent in financial systems. This means building institutions and policies that can function effectively during periods of extreme market volatility, rather than assuming such periods are temporary anomalies that will resolve themselves. The increasing complexity of financial instruments and markets doesn't necessarily make them more efficient or safer. Instead, complexity often obscures risk and makes it impossible for market participants to understand what they're actually buying or selling. When even sophisticated investors can't understand the instruments they're trading, markets lose their ability to efficiently price risk. This complexity also makes systemic risks harder to identify and address because problems can hide in interconnected webs of financial relationships. The lesson isn't that complexity is inherently bad, but that it needs to be accompanied by greater transparency and simpler ways to assess overall system risk. Financial innovation should make markets more stable and efficient, not just more profitable for a few sophisticated players. One of Soros's most important insights is that ideological beliefs about how markets should work often prevent us from seeing how they actually do work. Market fundamentalism became so entrenched that even sophisticated financial professionals couldn't recognise obvious signs of systemic risk. When ideology becomes more important than evidence, it creates dangerous blind spots that can lead to catastrophic mistakes. This applies not just to free market ideology, but to any rigid belief system that prevents adaptive thinking about market dynamics. The solution isn't to abandon all theoretical frameworks, but to hold them lightly enough that they can be modified or abandoned when evidence contradicts them. Intellectual humility becomes a crucial skill for navigating financial markets successfully. Traditional approaches to financial regulation assume that market participants are rational actors who will respond predictably to incentives and rules. Soros shows that this assumption ignores the psychological dynamics that actually drive market behaviour. Effective regulation needs to account for crowd psychology, cognitive biases, and the tendency for financial professionals to take excessive risks when they're not bearing the full consequences of their actions. This means designing rules that work even when people are behaving irrationally or are caught up in collective manias. It also means accepting that perfect regulation is impossible and building systems that can function even when specific rules fail or are circumvented. While government intervention may be necessary during financial crises to prevent complete economic collapse, such interventions create moral hazard problems that make future crises more likely. When financial institutions know they'll be bailed out if their bets go wrong, they have incentives to take even bigger risks. This creates a cycle where each crisis leads to interventions that set up conditions for the next, potentially larger crisis. Breaking this cycle requires finding ways to let financial institutions fail without destroying the broader economy. This might involve breaking up institutions that are too big to fail, creating better bankruptcy procedures for financial firms, or designing bailout mechanisms that impose real costs on the institutions being rescued. Modern financial crises don't respect national borders, but financial regulation remains largely national in scope. This mismatch creates opportunities for regulatory arbitrage, where institutions shop for the most favourable regulatory environment, potentially undermining attempts to control systemic risk. Effective financial stability requires international cooperation, but such cooperation is difficult to achieve because different countries have different interests and political systems. The lesson isn't that international cooperation is impossible, but that it requires sustained effort and institutional innovation. This might involve creating international financial oversight bodies with real authority or developing mechanisms for rapid coordination during crisis periods. Even when you understand that markets operate in boom-bust cycles driven by reflexive dynamics, timing these cycles remains extremely difficult. Bubbles can persist much longer than rational analysis would suggest, because the psychological and social forces driving them are powerful and self-reinforcing. Similarly, crashes can be more severe and prolonged than expected because the same reflexive dynamics work in reverse. This doesn't mean that understanding market cycles is useless, but it suggests that investment strategies based on cycle timing are likely to fail. Instead, the focus should be on building robust systems that can survive various market conditions, rather than trying to predict exactly when those conditions will change. The development of complex financial instruments isn't inherently problematic, but it becomes dangerous when it's driven primarily by the desire to circumvent regulation or obscure risk, rather than create genuine economic value. Financial innovation should make it easier to allocate capital efficiently and manage legitimate risks, not create new ways to concentrate wealth or shift risk to unsuspecting parties. This requires developing ethical frameworks for evaluating financial innovation that go beyond simple measures of profitability. It also means creating regulatory structures that can adapt quickly to new financial instruments rather than always being several steps behind market developments. One reason financial crises are so damaging is that most people, including many professionals, don't understand how modern financial systems actually work. Economic education typically focuses on theoretical models that bear little resemblance to real market behaviour. This leaves people unprepared to recognise dangerous developments or protect themselves from financial predators. Improving financial education means teaching not just technical skills, but also critical thinking about market psychology and systemic risk. It means helping people understand that financial markets are human institutions that reflect human psychology in all its complexity and irrationality, rather than mechanical systems that follow predictable rules. George Soros' analysis of the 2008 financial crisis offers more than just an explanation of past events. It provides a roadmap for understanding the fundamental nature of financial markets and human behaviour. His theory of reflexivity reveals why traditional economic models fail so catastrophically, and why financial crises are not random accidents, but predictable consequences of flawed thinking about market dynamics. The book's most powerful insight is that our beliefs about markets actually shape market reality in ways that make those beliefs either self-fulfilling or self-defeating. This creates inherent instability that no amount of mathematical modelling or regulatory fine-tuning can eliminate. Instead of fighting this reality, we need to design financial systems that can function effectively in an inherently unstable environment. Soros' warnings about the dangers of market fundamentalism have proven remarkably prescient. More than 15 years after the book's publication, many of the same ideological blind spots and structural problems that created the 2008 crisis remain in place. The belief that markets are always right continues to influence policy decisions, and the financial system remains dominated by institutions that are too big to fail but too important to restructure fundamentally. Perhaps most importantly, this book demonstrates the value of intellectual courage in challenging conventional wisdom. Soros didn't just predict the 2008 crisis. He explained why such crises are inevitable as long as we continue to misunderstand the nature of financial markets. His willingness to challenge fundamental assumptions about market efficiency and equilibrium offers a model for the kind of critical thinking necessary to navigate an increasingly complex and interconnected global financial system. The question isn't whether there will be future financial crises, but whether we'll learn enough from past ones to make them less devastating when they occur.